This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 442 was produced on August 22, 2024. I'm Erik Townsend. Saxo Bank's chief commodities strategist, Ole Hansen, returns as this week's feature interview guest. We'll talk commodities from precious metals to uranium, to energy, to agriculture, and get Ole's outlook on whether the deep correction we've seen in the commodity supercycle is over or not. Several of you emailed and tweeted asking me to respond to Peter Thiel's remarks about nuclear energy on Joe Rogan's podcast. I've just posted a new Substack post with that response at eriktownsend.substack.com, and it's also linked in your Research Roundup email. I really think we could make a difference in public understanding of nuclear technology and energy policy if I could just get the attention of Joe Rogan's team and do a full Rogan-length podcast on why we're currently focused on all the wrong nuclear technologies and what it would take to craft an intelligent nuclear-centric global energy transition policy. Not to do 3x nuclear, but to do 24x nuclear by 2050, something I contend is entirely possible and which would completely replace all of the energy we now derive from fossil fuels. But that won't happen without your direct and active support. If you want to help, please read the Substack post and do what you can to draw the attention of Joe Rogan's team to it. Podcasters listen to their audience, not to guys trying to promote themselves. Even little podcasts like MacroVoices pretty much ignore people that are promoting their own message and go by what other people say. So if you believe in my vision for solving climate change and energy transition with safe, clean, advanced nuclear technology, not the old school nuclear reactors, please do what you can to help.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, August 21st, 2024. The September S&P 500 futures up 299 basis points, trading at 56.41. The rally has been relentless off the yen carry trade lows. We'll take a closer look at that chart and the key technical levels to watch in the Postgame segment. The US dollar index down 140 basis points, trading at 101.13. The breakdown to multi-year lows after the jobs numbers revision. The October WTI crude oil down 516 basis points to 71.93. The breakdown testing long-term supports. We'll take a look at that chart in the postgame, and Erik will have the EIA inventory data. October RBOB gasoline down 465 basis points to 205. December gold up 274 basis points, trading at 25.47. One of the few persistent bull trends that continues. Copper up 371 basis points to 419. Uranium down 190 basis points to 79.85, and the U.S. 10-year Treasury yield down 8 basis points, trading at 3.83 as the yield continues to press lower. The key news to watch this week is Powell's comments from Jackson Hole, and next week we have the preliminary GDP, the core PCE price index, and the much-anticipated NVIDIA earnings. This week's feature interview guest is Saxo Bank's chief commodity strategist, Ole Hansen. Erik and Ole discuss the commodity supercycle, gold, silver, uranium, and more. Erik's interview with Ole Hansen is coming up as MacroVoices continues right here at macrovoices.com.
And now with this week's special guest, here's your host, Erik Townsend.
Joining me now is Saxo Bank's commodity chief, Ole Hansen. Ole prepared a slide deck to accompany this week's interview. You'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button above Ole's picture that says looking for the downloads. Ole, I love this picture of the 747 on the opening page here. Let's dive into the slide deck and talk about the next page, which of course is the table of commodities. A lot of things in the green this year, but give us the rundown.
Well, hello, Erik, and thank you very much for inviting me back. We're past the halfway mark, and I think the first observation is that if we look at the commodity sector as a whole, we're back to square one. The Bloomberg Commodity Index, which tracks 24 major commodity futures, is literally unchanged on the year, following a relatively strong rally during the later part of the first quarter and into the second. And then since then, the rally has deflated, and questions are clearly being asked right now whether the rally is done or what's going on in the market. But as we can also see, it's as per usual, some big movements are unfolding. I think those that have really attracted a lot of attention this year are also the ones that we can see on this performance, where we have precious metals out in front from a sector perspective. We continue to see gold making new record highs. Silver is struggling a little bit recently because of the weakness in the industrial metals, but that seems to be turning as well as we speak. And then there's big divergence in the agricultural space between soft commodities like coffee, cocoa, and orange juice, sugar as well, and then grains on the other side, which is really struggling with another bumper crop year across the northern hemisphere, leaving bread prices hopefully relatively subdued into the coming winter. And then in the middle, we got the energy sector, where basically we are, in the big scheme of things, we are now trading unchanged almost in crude oil for the past year and a half, and the range there is getting increasingly narrower. So obviously something is going to happen eventually.
Let's move on to page 3 and talk about this idea of a new commodity supercycle that so many people are talking about. What do we mean by a supercycle? Are we having one? It seems like we were off to the races, as you just said, but then the recession fears came, and now all of a sudden everybody's forgotten about it. Been quite a whipsaw here. What do we make of this? Was this the buying opportunity that we just hit, or are we still looking at some turbulence ahead?
If you look at the super cycles we had in the past, especially the big one that happened at the start of this millennium, I was in London trading for hedge fund that time. I remember this one very, very fondly. We had some massive run-up in commodities during that first decade. And then we had the stimulus-induced rally following the great financial crisis back in 2008, spanning a couple of years. And then we had the one that really kicked off with the pandemic back in 2020, where governments threw a lot of money into the system, and people consumers around the world went on a spending spree, and commodity prices were driven sharply higher, ultimately peaking when we had Russia's attack on Ukraine, which briefly brought some of these commodities to even higher levels. And we have deflated since then. And I think what there's no doubt about right now is that the demand outlook globally is not that healthy, especially when you look at China. I think China has been the big negative surprise once again this year. And while we saw this stimulus boom back in after 2008, and we also saw quite a bit of activity after the pandemic, I think the market is realizing this time that China is not going to throw money after new houses and construction, which is not going to be used. So we're seeing some commodities like iron ore and steel really struggling on that account, even crude oil. And I think some of the question that's being asked is whether we are starting to see the green transformation, especially in a place like China, where half the fleet now, a new fleet, is EVs and hybrid, where that's starting to have a peak impact on Chinese demand. But then other countries will pick up the baton. And so I think going forward, the bull cycle, I think, is still there, but is as much as it's going to be as a lack of supply than a strong demand-driven rally. And we've seen some false starts this year. We've seen some like copper off to the races in the belief that the green transformation would increase demand rapidly. It will, but it also highlights the fact that commodities are spot-traded commodities, products that you have to balance on a daily basis. And you cannot buy a commodity in the belief that it will be tight next year. It has to be tight now for the price actually to be supportive. And that's the experience I think we've had in the past 3 months, that some of these commodities probably had run ahead of themselves. Even though the long-term outlook looks great, then the short-term outlook is not enough to support the rally, and that's really where we are. But I highlighted several things, areas that could drive such a rally, and I think most of these are still really in place. And with that in mind, I think it's more a question of being patient than completely giving up on the idea that we're going to see higher prices.
Moving on to page 4, I think most of our listeners are familiar with the concepts of backwardation and contango. For anyone who isn't, just listen to one of Ole's previous interviews. But as we look over on the right side, what is the red line about? How does that relate to cost of funding, and what does it mean in terms of how these commodities are all performing?
Well, it basically means that you can go in and just check the spot price of a product and then check what the price is 12 months out. And then you can get the percentage difference between the spot price and the price 12 months out. And if the price 12 months out is lower than the spot price, then we have backwardation. If it's higher, then we have contango. And just to some of the classic examples right now, we have natural gas where the backwardation or the contango is quite extreme, basically meaning that the current price is way cheaper than what the price is expected to be in a year's time. And you can go in the other direction where we have something like WTI crude at the other end of the scale, where prices a year out is trading lower than the spot price, and that's backwardation. But the red line, that really is the neutral rate, you can almost say, because what is it they don't deliver that, for instance, the bond market delivered? That is interest. And that basically also means that if you are long commodities, you have to fund it. And what is the funding cost? And we use, as we're looking at the 1-year spreads here, we are also using the 1-year T-bill rate. And that was recently around 5%. It has started to come down as we anticipate rate cuts to start fairly soon. That basically shows that the red line is the neutral rate, because if you buy gold today, as an example, and you hold it for a year, then you're basically losing whatever the T-bill, the funding rate is. So that's around 4.5% right now. And that's what the red line is reflecting. So normally you would say contango, markets in contango, that's because they're oversupplied. But you have to move down the bar a bit in order to get the starting point correct. And that basically means, looking at the red line, quite a few of these are actually trading it almost what you can call backwardation, simply because the prices, the spreads are less than what the cost of the funding cost of the holding the position for a year. So as we move towards lower rates, as the Fed starts to cut rates, then the funding costs will come down. That basically means investing in commodities, in ETFs that invest into commodities. Gold is a classic example there. That will come down as well. And that potentially may open up new interest from investors that may have been balking at the idea of buying into commodities with this kind of carry that they had to pay away to be long in commodities. So that's why we're seeing this red line eventually starts moving closer to zero, and that will potentially attract some fresh demand into commodities.
Now, a lot of us, myself included, tend to only hold December contracts for long-term strategic holds. So, for example, in my gold futures position, I don't roll it over every month. I'm not trying to capture that month-to-month aspect of the term structure. I just roll the December contract from 23 to 24. I'm assuming I want to hold off and wait for some rate cuts before I roll my December 24 futures into 25. Any other considerations other than trying to kind of time the bottom of interest rates for when to do that?
That's by far the biggest consideration you need to have, Erik. And yes, you are right. As the 1-year rate has come down from 5 to 4.5, or even lower than that right now, that basically also means that the December contract has relatively outperformed the front month. So hold on to that as long as possible in the anticipation that we'll see 1, 2, or maybe 3 cuts before we get to the roll time in November. And apart from that, the relative tightness in the market, if some of that occurs, but we haven't really seen much of that recently. So really, most of the discrepancy or the price gap between the front month and the December contract is the cost of funding.
Moving on to page 5, let's go a little bit deeper on this gold bull market. I'm definitely bullish gold, but boy, it really does look like we're right at the top of the channel. That matches what I have on my chart as well. Should we be concerned here that it's time to take some profits, or are we maybe looking at a breakout above that channel?
Well, what we're telling our clients is at these kind of levels, because we just reached our revised target for the year, 2,500 on Friday. We had that at 2,300 at the start of the year. Obviously, had to revise it when we broke high, and I kind of used that channel also as a point, because again, whether it's 2,500, 26, 2,700, that's anyone's guess. But we have rallied a long way already this year. We're up around 22%. The corrections has been extremely shallow, and that basically indicates that there are buyers and dips in this market, and they have been active since at least since October last year. And knowing what we from the data we can collect as we move along, we can see that there is some major players in this market that is not that easy to see just from data, because we can see ETF flows, we can see net positions in the futures market, but we saw recently the World Gold Council just highlighting some like family offices and high net worth individuals in the OTC market. There were really substantial buyers during the second quarter. And that basically means that there are buyers in this market. And what we can see as well is that they are not interest rate sensitive, because interest rates has been going up since 2022. It has plateaued now, and now we're looking for cuts. The rally has occurred while rates were going up at the same time. So we have investors out there who are buying gold not because they're looking at trying to look for correlations to interest rates. They're buying it for other reasons, and some of the reasons they are well known, and we highlighted them on the left hand side. And I think the one that's really starting to sneak in as well is simply a great deal of uncertainty regarding the presidential election in the US in November. Because at this point in time, it really seems like we got two candidates willing to offer anything in order to get elected. That basically means they're going to spend a lot of money they don't have. And that means the debt burden of the US government is going to go up even further. I'm not saying we're seeing a default by all means, but just the risk of something breaking, I think is also one of the reasons why we're seeing family offices and high net worth individuals moving into gold. On top of what we're seeing already from central banks, who are worried about the clunking fist of the West taking their money away, like what happened with Russia, and this whole de-dollarization move, and then again, also in China, where the property sector was the preferred choice when it comes to investing for your future and for your retirement. That seems to have been broken for now. And that means middle class, wealthy investors in China, they look towards other markets, and gold is one of them.
Let's go a little bit deeper on de-dollarization and central bank demand, because I think that's where a lot of the buying has been coming from. Back in the day, what we used to say in professional finance is, the gold bugs might have a point philosophically, but the reality of the system is the entire system is designed around the US dollar. You can't just ditch the US dollar because all of the systems are designed around it. Seems to me like the pressure from other governments to eliminate some of those risks you talked about the U.S. being able to seize their assets and so forth, is maybe starting to force that change that a lot of people thought would never come. Am I right to think that? And if so, how long does it take before we have a realistic chance of the dollar being displaced as global reserve currency?
Oh, gosh. Something seriously needs to happen for that to happen. But I think it's mostly for now, and countries expressing the need to diversify and reduce their direct exposure in the dollar and dollar assets like government bonds and so on. What's categorizing the reserve currency are things like very, very deep liquidity and the general use, and the dollar is still really reigning quite on top when it comes to that, and liquidity especially. And all the talk about alternative currencies backed by other countries, well, it doesn't really help when some of these other countries still have currencies that they try to control themselves. It has to be free floating for that to really happen. But I think the move is ongoing, and it will continue. But for it really to have an impact, that will require a lot more gold to be accumulated. And if that is the case, then that underlying bid that we've seen in gold for the past couple of years looks set to continue.
Now, on page 6, you make the point that what happens to gold usually happens even bigger and better in silver. Seems to me in this cycle, though, silver hasn't quite outpaced gold the way we might have expected it to.
It did initially when we raised higher to 32.5, and I think part of that was simply the fact that we were making new record highs in gold on a regular basis, and the investors just took a look at the chart and say, well, hey, silver we hit $50 a decade plus ago and still well below its peak, so perhaps it's got some more upside. So that helped drive silver. But at the same time, also we have to remember 2 or 3 months ago we had a significant rally in copper, and both silver and copper they have a green transformation transformation story attached to them, and at the same time they also tend to a certain extent to be dependent on each other. Because silver, especially on copper, simply because copper represents the industrial metal space to which silver derives half of its overall demand. The correction we've had now recently has been quite deep, but just before that happened, silver was actually performing quite a bit better than gold on the year. So it's got some catching up to do, and for that to happen, it needs not only gold obviously to stick around these levels, but it also needs copper to find its footing after that quite significant correction it went through. And at the same time, also perhaps still some additional dollar weakness to spur along the move. And I think the prospect for all three to occur in the coming months, I think they are there. And with that in mind, silver potentially still has the percentage still prosper relatively better than gold this year.
Now, the other common wisdom that used to exist in precious metals markets was if you didn't want to get stuck having to pay that funding cost that we talked about, the full carry contango in the gold futures market, the smart trade was you'd buy the gold mining shares because they actually gave you leverage to the price of gold. Except that it seems like that just broke down completely and doesn't work anymore. Is that just inflation making it harder to stay profitable in the mining business, or what's going on?
It is a combination of several things, but actually, if we look at some of the mining companies' performances, it's mostly the industrial miners that has been struggling. Gold miners have actually been picking up the pace reasonably well recently. If you look at something like Newmont and Barrick Gold, they are not Barrick because they have some mergers they're trying to get through, but Newmont is up around 23% year to date, so actually outperforming gold. But some of the others has been struggling to a certain extent, and part of that story, yes, is absolutely the question of cost of production, which has been going up as well. We've all been exposed to inflation now for the past few years, and that's also hit the sector. So the profitability has been struggling a little bit, and then there's this whole problem with new investments and new finds. It just takes more than a decade really for them to make money on new assets they find. So the volatility is in the miners, but generally, yes, it is a question of cost that has left them by the wayside. But again, if gold continues to move higher here, and as it has been doing now for the past couple of months, then the profitability of the production will ensure that they will generate some good revenues, which should benefit the price.
I'm sure a lot of our listeners are in the same boat that I'm in, which is for the last several years, I've had long positions in both gold and gold miners, and I see the underperformance of the miners, and I scratch my head and I think, well, look, I'm convinced that gold is headed all the way up to 2,500, and when it gets there, surely the miners will have recovered. That's when I'm going to go ahead and cash out of my mining shares. But it hasn't happened yet. Should I just give up and cash out of the mining shares and increase my allocation on the gold longs, or is it worth holding out a little longer?
I think it's worth holding out, especially if the belief in higher gold price now that the funding cost starts to come down. Because remember, if funding cost starts to come down, then the cost of production starts to come down as well. So it's kind of a double whammy that these companies are going to get. Not only are they potentially seeing higher prices because investors get involved with gold as the cost of carry comes down, but the mining companies, they see their potential cost of production go down as well because of the lower funding costs. So I think that these two could be quite a decent force that could start to see these companies perform again.
Let's move on to base metals on page 7. Copper is, of course, the favorite child of the green energy movement and energy transition, because in order to electrify the economy, we need so much copper, and there's really no good replacement for it. Aluminum can be used instead of copper, but it costs more. So what do we see, and are we at a buying point here? It looks like we just had a really significant correction and touched that trend line, and we're bouncing off of it.
I think we are at a buying point, and I think we've seen a lot of speculative froth come into the market. Remember back in March, April, when we had the massive run up in AI stocks, investors were looking for alternatives. Perhaps were worrying that the rally had run away from them, and then suddenly copper became, well, hang on, the focus that, all this AI needs data centers. Data centers need electricity. They need copper. So the AI story is going to be a copper story as well. And that was probably part of the final leg we saw higher in copper. are. Then also simply the strong momentum from fund buying, because funds, they watch the price. Speculative traders like hedge funds, they will watch the price and price action, and if there's momentum, they'll continue to buy into strength until the market capitulates or until it reverses. Basically, we were left with a market where the fundamentals, the short-term fundamentals, did not underpin or support the prices that we were seeing, and the consequence of that was quite a significant retracement back down to this $4 level in high grade on the we see on the chart there. I think the market has flushed out the longs. If you look at the COMEX copper future, the net long has collapsed by 90%. We're nearly back to neutral. That basically means there's potentially a lot of fresh new money that can move back into the market when the technical or the fundamental outlook play ball. The technical outlook is starting to improve. The fundamental outlook probably needs some more work to be done, simply because we have seen this big spike in copper inventories at exchanges monitored by the big exchanges in London, New York, and Shanghai. And just last week, we did see a small reversal. But what we have seen in the past few months is that inventories have started to come down in China, but they've just been exporting it out of the country because there was an arbitrage, and that basically means it's gone from Shanghai focused or monitored warehouses into LME monitored warehouses. We're not really out of the starting block yet, but I'll be watching these inventory levels quite closely in the coming weeks. That we need to see those start to reverse lower, and that could be a good sign. At the same time, we have some labor discussions going on in Chile right now. Last week, probably the rally kicked off with the risk of a strike action at the world's biggest mine in Chile, run by BHP, the Escondida mine, but that was solved over the weekend. But there are still quite a lot of units that need to agree on wage packages for the next 2 to 3 years. So that's one we need to watch. But generally, the speculative froth is out of the market, and the long-term outlook, in my mind, is most certainly still one where copper will be supported, simply because mining companies are more busy trying to cannibalize each other. They're buying each other, trying to buy each other's assets instead of trying to find new assets, simply because it's too expensive and it takes too long. 12 years on average now from first discovery to first metal, and that basically means we are potentially looking into a shortfall in the coming years. Not right now, and that's why the market has come down, because this market, you cannot buy copper in the assumption it would be tight in 1 or 2 years' time. You have to look at where is the situation right now, and right now it's still reasonably well balanced, perhaps with an overhang of supply, and that's why the prices come back down again.
Ole, you're describing an imbalance between short-term and long-term fundamentals in terms of supply and demand mismatch. It just brings to mind another trade that many of our listeners are in, which is the long uranium trade. Feels to me like we've got an extremely long-term bullish opportunity, but maybe short-term is not quite in fashion right now. Is that what you think is going on, or do you have any other perspective on the uranium market?
Well, I think just one word, absolutely. The kind of developments we've seen in those two metals this year has almost been identical. Quite a lot of speculative interest coming into the market at the start of the year, only for the supply and demand outlook not underpinning the very high price levels that we reached. In uranium was 110 or something that we reached at one point. Now we're back into the 80s. We're down on the year. So I think it's the same story that's playing out there, that a lot of these investments had gone into not only uranium through ETFs, but also mining companies. There's been some dissatisfaction with that performance, and that basically led to some additional selling. So I think, again, just like copper, it is a question that we will see additional rollout of nuclear power in the coming years. Supply is likely to become reasonably tight, and that, I think, is going to be underpinning prices as we move into the future. But again, it happened too soon. In the spot market, the daily balance has to be is what really dictates the spot price, and we've had an ample supply at this point in time, and that's been setting prices down. As we go into the future and demand starts to tighten, or supply starts to tighten up and demand goes up, then we should see uranium start to recover.
As I think about that same phenomenon of imbalance between short and long-term supply-demand fundamentals, the next commodity that comes to my mind is crude oil. Hey, look at that. Next slide, crude oil. Page 8. What do we got here?
Well, on face value, we have a very boring market, to say the least, at least for the last year and a half. And you can say that's probably the success of OPEC Plus and their ability to maintain a stable stable price by cutting production. So it does indicate a market that would have been significantly lower if OPEC Plus hadn't taken barrels out of the market. And that raises obviously the question: well, can they ever get these barrels back into the market? And that's where some concerns are starting to come in from some of the data we see, that especially China, where it looks like oil demand is going to peak this year. We have fuel refinery activity falling on a year-on-year basis, simply because the rollout of EVs and hybrids in China is really quite aggressive right now, and they're also trying to flock their cars to the rest of the world, and that is starting to have a slow impact. So we're trading near 80 in Brent. Sorry for the American listeners, but I just tend to use Brent simply because of the global benchmark. So even though the liquidity and trading in WTI is probably way bigger than what we see in Brent, but Brent is currently trading around 90, and I'm sure that this is not the level OPEC were looking for. They were looking at 90 plus, and at this point in time, it's difficult to see how we can get back to that level, especially with all the spare capacity that has been building up as OPEC cut production. Then obviously spare capacity rose, and it's going to be interesting to see whether we will actually start increased production this October as they planning to. I believe they won't. I don't think the market is. I think the market is too fragile at this point in time for that to take. But at the same time, we're also seeing speculative interest through the futures market has really collapsed. We saw we're coming to that later in the cut report, but we saw Brent net long fall to a record low, basically since they started recording cut data of Brent back in 2011. So positioning is extremely light. So that does obviously support an upside surprise if something should change on a fundamental outlook. What I'm also watching is this massive gap between what OPEC believes demand is going to be this year, and again, if they base their production hike on an assumption that demand will grow by more than 2 million barrels, as they've been steadfastly holding on to for many months now, then they're probably right. But if the IEA is closer to the truth, with less than 1 million barrels, then there's no room. So we're probably going to end up somewhere in between. But it's just astonishing to see that even with 8 months of the year gone, and we are now trading October contracts, that we still have such a discrepancy in the outlook for this year. And so yeah, it just makes you wonder.
Let's bring term structure into this conversation, because it seems to me, if I look at the charts, they frankly look pretty darn bearish to me, and I think you can make the argument for economic slowdown and so forth. But boy, when I look at the term structure of WTI, and that's, I have to apologize, you're on the Brent chart, I'm on the WTI chart. I look at not only a very steep backwardation, but that backwardation is not falling off at the very front of the curve as it very typically does when you see the beginning of a move toward contango. And although we did see some sell-off in that backwardation, it seems to be picking up again. I'm reading on Twitter about people talking about fears of tank bottoms in Cushing. We've had significant drawdowns in Cushing inventory, even as the national inventory has built in the same week. It seems to me like physical market tightness is a theme that maybe not everybody's talking about, but ought to be.
True, and there's no doubt, looking at the numbers, that WTI has got a bigger prompt tightness than the one we're seeing currently in Brent, and part of that has to do with Cushing. Well, again, Brent is the global benchmark, and where the market has been focusing somewhat on the weakness in Chinese demand. But again, I think that the fact that it's not high in Brent does also indicate that the market is having a very lukewarm approach to the Middle East and the potential risk to supplies. Basically, there's not a strong enough bid in the spot market there right now. But overall, yes, the market is still in backwardation, and especially in WTI, it's quite elevated, and I think there's something to do with it. There's been some flow reductions from Canada, I believe, down to Cushing, which is part of the story of lower inventories. But it's most certainly one that's keeping the prompt spreads relatively tight, and as long as we don't see these switch into a contango, then perhaps the market is running a little bit ahead of themselves in terms of expressing too much of a negative view on prices.
Let's move on to agricultural commodities on page 9. What's the story here?
Simply that we have a major discrepancy between the soft sector and the grain sector. We all been watching this steep rally in cocoa prices. We also know that coffee prices, especially the one Robusta produced in Vietnam, is hitting record highs. Arabica from Brazil, which is traded in New York, is also up quite substantial. And then we got orange juice also trading up by quite a big percentage. And apart from the orange juice is South America, but also obviously Florida. But you can almost, maybe a little bit too generalistic, say that we have a discrepancy in the weather between the north and the southern hemisphere. The southern hemisphere is really struggling the most with very, very high temperatures that we're continuing to see making new record highs, and that these have really been challenging the crops of some of these soft commodities. We know the story with cocoa in West Africa. We also know the story about coffee in Vietnam. But generally, the very extreme heat that we've seen has been underpinning prices of soft commodities. If you turn to the grain market, which is mostly, apart from Brazil and Argentina, it's really a North American and European story. And once again, just like last year, the weather has been relatively benign and quite crop friendly, and that basically means we're left with an overhang of supply from last year, which very soon is going to be built up even further as this year's harvest is going to hit the silos, and that basically means we got ample supplies, and that's adding downward pressure to prices almost for a second year running. So the grain sector is really not only the most sold market and the biggest shorted market by hedge funds, but it has been a very profitable trade now for quite a long time, and it just highlights how weather is a major influence on food commodities, because we know how many people we are in the world, we know how many animals there are, how much feed we need, also to a certain extent how much needs to be used towards biofuel production, and that basically leaves the supply side as the one that adds the volatility to the market, and we've seen a lot of that volatility now in the past year and a half.
I'm going to ask you to weigh in on a speculative trade that I've been entertaining in the grain market, which is I just look at this escalation in the Russia-Ukraine conflict, and now Zelensky is talking about seizing the land in Kursk and kind of turning the tables on Russia and saying, we're going to keep some of your territory instead of you keeping some of ours. Look, I have no idea who's going to win or lose in that fight, but it seems like things are heating up, and I know that Russia and Ukraine combined make up a massive percentage of the wheat market globally. Does it make sense to consider a speculative trade there? Is it a bull call spread? Is it another trade? What do you think about that view?
I think the level of production that if we've gone through a troubled growing season elsewhere and we were heading into the winter with tight supplies, then yes, then it would most certainly have a much bigger impact than what we're seeing right now. Russia is a major exporter, and they will continue to be able to export, weather permitting. And it looks like now an early scare has been mitigated by decent weather here towards the harvest period. So Russia has lots of supplies that they can export, and if they were struggling to export, then buyers would just have to go somewhere else. They have to go to Chicago and pick up the wheat. So I think we tried it on a couple of occasions because there's been plenty of bad news being presented to us in the last 2 years with the war in Ukraine, and the one was the biggest one was the initial invasion where the market really worried that we were going to see exports drop completely. That didn't happen, and even though some of the export facilities in Ukraine gets bombed on a regular basis, they still managed to get the wheat out, and Russia most certainly as well. So I think it's a difficult one to trade, and again, looking at spreads, that should obviously then be within the same crop year. We're comparing spreads for a futures price from one year to the next is like apple and pears because there's a new season in between, which is weather dependent. But generally, I will struggle to find the right trade for that. I've been looking at milling wheat trade in Paris. France is heading for their worst wheat crop I think since the 80s, and the wheat contract in Paris has hardly moved to the upside simply because there's ample supplies coming in from elsewhere, and that just highlights how difficult it is to speculate in the squeeze when there are multiple sources of supply as there is right now.
The best source of analytical data in the entire commodities market is probably the government's Commitment of Traders report, which indicates where big traders are positioned. Problem with the government data is it's not well visualized. It's very cryptic and difficult to decode. You do a fantastic job of reorganizing that official government data, putting charts to it, getting all kinds of visual cues to indicate trends and so forth. And you give that away for free. How come you give it away for free? Where can people find it? And walk us through what slide 10 is telling us about the Commitment of Traders report.
Well, thank you for that, Erik. I've been following this report since I was a trader myself back in the days in London, and really found it useful simply to get an idea about how the big boys were positioned and whether they were getting too overextended in either to the upside or the downside. So just like everyone else, I picked the data from CFTC when they publish them on the Friday. I normally send out a couple of tweets during the weekend, just highlighting the main movements in the commodity space, but also the forex space. Where actually, as a buy note, we've seen a phenomenal amount of buying of the yen. This momentum crash, or deleveraging crash we had at the start of August has just seen a phenomenal amount of yen buying. We're now seeing the first long there since 2021. The gross long is the biggest, highest since 2016, and these are historic moves that we see. But that's another side. I published it, as I said, on Twitter, but then we obviously Saxo Bank has a website and a trading platform, and that's where we tend to publish the articles that come with it. But I put them out on Twitter as well for everyone to see. So, and as I said there on the slide, there's a lot of numbers, but what's really important is just to see take a look at the change and the net, and how the net has been developing in the previous weeks, and if there's been some major changes, if something has started to get too elevated. And last week was a classic example, simply because we had that momentum crash. And even though it was a question of yen and AI and other very popular stocks taking a hit in the initially, then the whole deleveraging where volatility spiked also hit commodities, because commodities is not an isolated part of the investment world. If volatility goes up one place and you are a fund manager investing across markets, you are forced to reduce your overall exposure. That takes some of your exposure in commodities down as well. And just last week, as I mentioned, the Brent long, which is now as of last Tuesday, was just around 70,000 lots. That saw a 174% increase in that week. So basically, we came from a record low, and that leaves this market extremely exposed to a recovery. If there's anything that sniffs of a recovery in either the fundamental or the technical outlook, and that's what we saw in that week where the Brent price returned to at one point trading above 80, and it just also highlights the very big short we're seeing in the grain market right now. But for now, it's being fundamentally justified, and the technical outlook has to improve quite significantly for that to be reduced. But when and if that happens, then there will be a massive short-covering rally in the grain market. But it's difficult to see what really should trigger that right now. And just finally, by far the biggest position right now is, I think it's more than probably 70-80% almost of the total nominal exposure is in gold. And that tells two things. Obviously, that there is a strong momentum in gold. Also, that the corrections that we've seen since the breakout in February, March, when we broke above 2,200, that have been so shallow that hedge funds had not been forced to adjust their positions. And that's normally what creates a lot of volatility, because in the first few days after entering into a position, they are they're very trigger happy, because if it doesn't go in the right direction, they will reduce some of their exposure straight away, because they don't want to be caught out by too much. But we haven't really seen that in gold. And at this point in time, gold needs to correct by at least, I would say, $150, perhaps even $200 for this really to start to hurt and to trigger some long liquidation. And that's why the gold rally has been so relatively low in terms of volatility, because there hasn't been any major need to adjust positions, because simply the move has been so one-sided.
You've got a contact information page on slide 12, which our listeners can use to see where to find you. But before I let you go, please tell us a little bit about your own podcast that you produce for Saxo Bank.
Yeah, well, it changed a little bit in recent months. Yes, we used to do a daily one. It was growing in popularity, but we also had to take stock and see whether we were doing the right thing. So we're changing now to a weekly, more of a dialogue, one or two or three in the room, and by the time this episode is broadcast, we have recorded one where we will be looking at some of the same themes that we've been talking about today, Erik, but also how that works together with the equity market, whether there are some opportunities in the equity market related to commodities, and again also just discussing some of this about this cycle, the so-called super cycle. So we do that on a thematic basis, on a weekly basis. Normally comes out on Tuesdays.
Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at macrovoices.com.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
It's great having Ole back on the show. Now joining us again in the post-game is Nick Galarnik. Now let's get to that chart deck. Listeners, you're going to find a download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Ole's picture saying looking for the downloads. Now, Erik, let's start with crude oil and the EIA inventory.
EIA printed drawdowns across the board, and they were big ones. Crude oil drawing down 4.6 million barrels. Cushing, Oklahoma drawing down 0.6 million barrels. Gasoline drawing down 1.6 million barrels. Distillates drawing down 3.3 million barrels. That's a net petroleum products drawdown of a massive 9.5 million barrels. Meanwhile, U.S. production ticked back up 100,000 barrels to 13.4 million barrels. That's an all-time high on the weekly data series, and let's cross our fingers, maybe it's the beginning of a new trend. Can I hear 13.5 instead of 13.4 in coming weeks? Let's see what happens. But even that gigantic inventory draw wasn't enough to keep the market from selling off after inventory to retest the early August lows at a 71 handle on WTI. While the flat price is clearly suffering, we're still in a reasonably steep structural backwardation. So the physical market is sending a very different signal than the flat price. I still think geopolitical risks are underpriced by this market. But frankly, I've said that many times before, not to mention losing money betting on that view, only to be proven wrong, at least for now. But longer term, I really do think that we're headed higher on energy prices.
Yeah, the price action has been incredibly weak, remaining below its 50-day moving average. All little rallies are immediately sold into, but we are approaching very key support lines all the way through 2023 and 2024. This $68 to $72 area has been where all of the short-term support lines have come in. With us in this oversold state and approaching these levels, it will be likely that we're going to at least get a reaction and a support line holding on the first test. What will be far more interesting is if that can establish a bottoming formation there throughout the remainder of August and early September, and whether or not that could be a turning point. At this stage, we're just going to be watching how the price action behaves along this key support line while it's still in this primary downtrend. Or let's move on to the equity markets. Nick, I want to talk to you about the levels. What are you watching here on the S&P?
Right now, spot price on SPX is approximately 56.30, and we have an implied move for the September 20th monthly OPEX of plus minus 170 points. Therefore, we have an upper implied move of 5,800, which would mark new all-time highs, and we have a lower implied move of 54.60. Right now, we have key resistance at 56.70 all-time highs and key support at 5,500. I'm inclined to think we see some more chop, perhaps a smaller move to the upside into the middle of September, but I'm not overly bullish right here. I think we're going to see more of a kangaroo market into the election cycle.
Yeah, the S&P 500 had the slingshot rally from a very oversold state, now approaching its previous highs. There's very little asymmetry in pressing a new long, especially when we have trigger points such as NVIDIA's earnings coming up and Jackson Hole tomorrow. We're going to see whether or not that spurs maybe a little bit of a distribution cycle. The one thing I would say is that the market has really neutralized the sell cycle. There really is, it would take a lot of technical damage in order for us to turn the trend back down. And so it's very likely, even if there was a 100, 150 S&P point pullback, that it's very easily going to find support at that 5,500 5,800 level you just referenced, and we stay stuck in a trade range until some of the bigger news events in September. Well, let's move on here on page 4. I have the QQQs. What levels are you watching here on the NASDAQ?
Right now, spot price on Qs is approximately 484, and we have an implied move for the September 20th monthly OPEX of plus minus 20 points. Therefore, the upper implied move is at all-time highs of 504, and the lower implied move is at 464. Right now, we have key resistance at all-time highs at 504 and key support at 465. Right now, as I said before on SPX, I'm not overly bullish on the tech. I think that there are some names that make sense to go long. For example, PayPal and Google, I'm long on right now, as well as Palantir and Shopify. However, I'm trimming my positions on the latter two. But I do think we see more of a chop market into that election cycle.
On page 5, I have the volatility index, and obviously we talked last week about that huge spike and pullback. But what's interesting is that we're now finding a little bit of a higher elevated level on the VIX, which is consolidating here at the 15-16 level. What are you watching here on the VIX?
So with the VIX at a 16 handle approximately, we expect to see top to bottom intraday moves of about 1% on SPX, and insurance getting a bit cheaper into the election. However, it's still elevated from where it was a few weeks ago. I think that Powell's commentary tomorrow for Jackson Hole will be very key in determining where we go next, as well as if we spike on the VIX or not, which would correlate with the downside move in broad markets. But overall, I think we're going to see business as usual, where we see more chop and range between the 14 level on the VIX and about 20. If we do spike above 20, it's likely we see a spike higher to 25 to 30 perhaps in a very, very fast window, kind of like we saw a few weeks ago. Moving on to page 6, we have that US dollar index. What are your thoughts here?
Wednesday's close below 102 on the September Dixie contract seems to confirm Louis Gave's view that we've entered a new bear market in the dollar. But there are so many variables in play that anything's possible, and another big geopolitical escalation could easily trigger a flight to safety rally for the dollar.
Yeah, I find it very interesting where the dollar is right now. As we approach the 2023 and 2024 lows on the dollar index, we have a very oversold dollar. The euro's at its a key overhead resistance. The pound's at its previous highs. The US dollar yen just did a fib retrace retest along its lows. There's a lot of reasons why the dollar may react off of this support line and offer even 1 or 2 points on the upside. The bigger question to what you're suggesting there as well is that when will we have a more meaningful turn in this trend, and will we have one of these flight to safety events occur, especially going into the September-October period? Right now, all we have is a very oversold market that's in a primary downtrend, trading right into major support. So let's see whether or not we get a bounce here.
Now on page 7, we have that gold futures chart, which is making new all-time highs. What are you guys thinking here?
Well, the bull market rages on, but by any reasonable measure of technical analysis, there's a very strong argument to be made that we may have just hit a swing high at 2570 on Tuesday. Now, that was a perfect test of trendline resistance. The slow stochastics are well into overbought territory, and a lot of analysts' longer-term targets have already been met. I happened to be sitting in front of my screen watching live when we briefly traded over 2570 on Tuesday, and I was sorely tempted to take some profits in expectation of at least a normal swing correction back down to, 2475, 2485, in there somewhere, where I thought I could buy back a larger position than what I took off the table. But frankly, last time I tried to get fancy and trade in and out of my gold position, I shot myself in the foot. And a big geopolitical escalation in the Gaza or Ukraine conflicts could easily take this market much higher, regardless of the fact that we're already in overbought territory. So I'm standing pat. I don't think this bull market is anywhere close to over, but there are plenty of good reasons to brace for a $50 to $100 move below Wednesday's close, simply as a normal price swing. If we get that correction, I'll definitely be adding to my longs below 2,500.
Yeah, Erik, all of the highs from April and May occurred around that 2450 area, and that's also where that 50-day moving average is. After this little impulse higher, there's obvious room for gold to have these kind of $50 pullbacks like you were suggesting, but anything that falls back towards there, you have to assume is going to be a buy on dip opportunity. We're going to be watching as well whether or not this trend can continue towards the different measures measured targets, which are all lying in that 26 and 2700 level on the upside. The key takeaway, though, is that gold has been one of the few things that has remained in a decisive bull trend. Higher highs, higher lows, well accumulated, well defended, never really pulled back deeply when many other commodities were going through substantial corrections. And that generally is a sign of good accumulation. And I think that you have to respect that this prevailing trend can stay dominant in the months to come.
Now, moving on to page 8, we have that uranium chart. Erik, what are your thoughts here?
Well, the market is holding its bounce off the August 5 lows, but frankly, the recovery is anything but robust. I stand by my conviction that the fundamentals couldn't be better. Also, from a seasonality perspective, we've got the World Nuclear Association conference coming up September 4th through 6th, and that also has historically been a bullish catalyst. But there's also plenty of room to make the argument that the charts are still looking pretty weak from a technical perspective. I also see a couple of downside risks that I don't even know how to gauge because there's simply no precedent. One is the possibility of a tactical nuclear weapon being detonated in an escalation of either the Ukraine or Gaza conflicts, and the other one is the possibility of either the Kursk or Zaporozhye nuclear power plants. There's one in Russia and one in Ukraine. Either one of those being bombed or otherwise compromised by military action in a way that results in some kind of leak of radioactive contamination. Now, would either of those events cause the public to freak out and decide nuclear energy is bad just because a nuclear power plant was damaged in a military action or because a nuclear weapon was detonated that had nothing to do with nuclear power? Well, there's clearly no sane logical reason for anyone to reach those conclusions. But frankly, there was no sane or logical reason for the anti-nuclear sentiment that occurred in the wake of the Fukushima incident. And that cost us a full decade of very strong anti-nuclear sentiment. So who knows what's possible if one of those risk events were to eventuate? On the bullish front, China announced about a dozen more reactors this past week and continues to lead the world in the nuclear renaissance. We in the West need to catch up. And again, there's more about that in my Substack post, which is linked in your research roundup, or you can find it at eriktownsend.substack.com.
Yeah, the distribution cycle is relentless here, just continuously lower highs, lower lows, staying in a primary downtrend. At some point, this will trigger a new buy signal, but technically there is no sign of it right now. We're watching closely. I want to touch on a number of other commodity charts that Ole was referencing. On page 9, I have this copper chart, and what we have was a very oversold market that has now bounced, but the primary trend is still down. And while we probably are much closer to the bottom than we were to the top that occurred back in May, I still think there's going to be a prolonged bottoming formation. I would not be shocked here if we retested $4 or lower numerous times, establishing a base that might take the entire month of September to really form. At some point, there will be a base that we can look for a new bull opportunity to form, but probably at this stage, we may be waiting all the way into the fourth quarter for a new buy signal. I wanted to end with, on page 10 and 11, I have the chart of wheat and soybean, and just as an example of just how persistent the downtrend has been in this ag space. At some stage, these oversold conditions are going to be given a new catalyst for a reversal. But right now, this is a good example of what's happening in the entire broad commodity basket. It's just been relentless selling. At some point, this is going to be a phenomenal opportunity, but there really is no technical signs of things like the bottoming formations, double bottoms, reversals, patterns of breaking descending trend lines. We're going to eventually see that, but it's no sign right now. And so again, this is probably going to take the entire month of September to establish key bottoming formations before we can get some new buy signals.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the chart book we just discussed here in the postgame, including a link to a number of articles that we found interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend. That is Erik spelled with a K. And follow Patrick at Patrick Ceresna. On behalf of Erik Townsend, Patrick Ceresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.